Stop guessing. Master fundamental analysis for smarter investing. Hey everyone, and welcome back to X100%. It's Eddie here, your guide on this journey to financial empowerment. Today, we're tackling a topic that might sound intimidating at first, but trust me, it's the bedrock of smart investing, fundamental analysis. Now, I know what you might be thinking. Eddie, that sounds complicated. Spreadsheets, financial jargon, ugh. But hold on. I promise to make this not only understandable but also engaging. Think of it as becoming a financial detective, uncovering the true worth of a company before you even consider investing. We're not just going to throw around definitions and formulas. We're going to tell stories, share real-world examples, and even dive into some of my own investing experiences. The wins, the losses, and the crucial lessons learned along the way. So grab your favorite beverage, maybe a notepad, and let's get started on this adventure into the heart of fundamental analysis. So what exactly is fundamental analysis? At its core, it's about determining the intrinsic value of a company. What's it really worth based on its financial health, its industry position, and the overall economic landscape? It's like peeling back the layers of an onion to get to the flavorful center. Think about it this way. Imagine you're buying a house. You wouldn't just look at the fresh paint and the manicured lawn, right? You'd want to know about the foundation, the plumbing, the electrical system. You'd hire an inspector to dig deep and uncover any potential problems. Fundamental analysis is the same thing, but for stocks. We're looking beyond the current stock price, which can be influenced by emotions and short-term trends, to see if the company is a solid investment. The ultimate goal? To find stocks that are undervalued. That means the market price is lower than what we believe the company is actually worth. It's like finding a vintage guitar at a yard sale for a fraction of its true value. Now, who wouldn't want to do that? Now, to become these financial detectives, we need tools. And in the world of fundamental analysis, those tools are a company's financial statements. These are like the blueprints of a business, giving us detailed insights into its performance and financial health. There are three main financial statements we'll focus on today: the income statement, the balance sheet, and the cash flow statement. Think of them as a trilogy, each telling a crucial part of the company's story. First, we have the income statement. This shows a company's revenue, expenses, and profit over a specific period, usually a quarter or a year. It's like a report card for the company's profitability. Did they make a profit? How much did it cost them to operate? The income statement answers these questions. Next up is the balance sheet. This is a snapshot of a company's assets, liabilities, and equity at a specific point in time. It's like a financial photograph showing what the company owns, assets, what it owes, liabilities, and the difference between the two, equity. The balance sheet tells us about the company's financial stability and its ability to meet its obligations. Finally, we have the cash flow statement. This tracks the movement of cash in and out of a company over a period of time. It's crucial for understanding if a company can pay its bills, invest in its future, and weather any financial storms. A company can be profitable on paper, but if it's running out of cash, it's in trouble. Now, I know these terms can sound intimidating, but don't worry. We'll break them down and see how they work together to paint a complete picture of a company's financial health. Okay, we've got the financial statements. Now what? This is where ratio analysis comes in. Ratios are like financial shortcuts, helping us compare companies, identify trends, and understand their performance in a more meaningful way. Think of ratios as a way to level the playing field. Comparing the raw numbers of a small company to a giant corporation isn't very helpful. But comparing their ratios can give you valuable insights. Let's look at a few key ratios that every investor should know. First, the price-to-earnings ratio, P/E ratio. This tells us how much investors are willing to pay for each dollar of a company's earnings. It's calculated by dividing the company's stock price by its earnings per share. A high P/E ratio might mean the stock is overvalued, while a low P/E ratio could suggest it's undervalued. But remember, context is key. A high-growth company might deserve a higher P/E ratio than a mature, slow-growing company. Next, we have the debt-to-equity ratio, D/E ratio. This shows us how much debt a company has compared to its equity. It's calculated by dividing the company's total debt by its total equity. A high D/E ratio could mean the company is taking on too much risk, as it has a lot of debt to repay. However, some industries, like utilities, tend to have higher D/E ratios than others. Finally, let's look at the return on equity, ROE. This measures how efficiently a company is using its equity to generate profits. It's calculated by dividing the company's net income by its total equity. A high ROE is generally a good sign, indicating that the company is effectively using its shareholders' investments to generate returns. Remember, no single ratio tells the whole story. We need to look at these ratios in context, comparing them to industry averages, the company's own historical performance, and the overall economic environment. Now, fundamental analysis isn't just about crunching numbers and calculating ratios. It's also about understanding the qualitative factors that can impact a company's value. These are the things you can't necessarily measure with a spreadsheet, but they are just as important, if not more so. Think about it. You can have a company with great financials, but if it's run by incompetent management or faces a major disruption in its industry, its stock price is likely to suffer. So, what are some of these qualitative factors? First, the company's management team. Are they experienced and capable? Do they have a clear vision for the future? Do they have a track record of success? A strong management team can make all the difference in a company's performance. Next, the company's competitive advantage. Does the company have a unique product or service that sets it apart from the competition? Does it have a strong brand name? Does it have a loyal customer base? A strong competitive advantage can help a company maintain its profitability and market share over the long term. Finally, the industry outlook. Is the industry growing or declining? Are there any major trends that could impact the company's performance? For example, the rise of electric vehicles is disrupting the traditional automotive industry. Companies that adapt to this trend are likely to thrive, while those that don't are likely to struggle. These qualitative factors can be subjective, but they are crucial for making informed investment decisions. Okay, let me share a story from my own investing journey that highlights the importance of both quantitative and qualitative analysis. A few years ago, I was looking at a company in the retail sector. On the surface, the numbers looked fantastic. Revenue was growing, profit margins were healthy, and the stock price was steadily increasing. I was tempted to jump in and buy the stock. But before I did, I decided to dig a little deeper. I started reading articles about the company and its industry. I learned that the company was heavily reliant on a single celebrity endorsement. If that celebrity's popularity waned, the company's sales could suffer. I also learned that the company was facing increasing competition from online retailers. Consumers were increasingly shopping online, and this company was slow to adapt to this trend. Based on these qualitative factors, I decided to pass on the investment. And guess what? A few months later, the celebrity endorsement deal fell apart, and the company's sales plummeted. The stock price crashed, and investors who had bought the stock based solely on the numbers lost a lot of money. The lesson here? Always look beyond the numbers. Understand the qualitative factors that can impact a company's value. It can save you from making a costly mistake. So, how do you actually do fundamental analysis in practice? Here's a step-by-step approach that you can use to evaluate any stock. Step 1. Choose a company. Start with a company you're interested in. It could be a company whose products you use, a company in an industry you understand, or a company that's been in the news. Step 2. Gather financial statements. Find the company's income statement, balance sheet, and cash flow statement. You can usually find these on the company's website in the Investor Relations section, or on financial websites like the SEC's Edgar database, Yahoo Finance, or Google Finance. Step 3. Calculate key ratios. Use the financial statements to calculate key ratios like P/E, D/E, and ROE. You can find calculators online to help you with this. Step 4. Analyze qualitative factors. Research the company's management team, competitive advantage, and industry outlook. Read articles, listen to earnings calls, and do your own research. Step 5. Determine intrinsic value. Based on your analysis, estimate the company's intrinsic value. This is where things get a little more subjective. There are different methods you can use to estimate intrinsic value, such as discounted cash flow analysis or relative valuation. Step 6. Compare to market price. If the market price is lower than your estimated intrinsic value, the stock might be undervalued. If the market price is higher than your estimated intrinsic value, the stock might be overvalued. Step 7. Make an informed decision. Based on your analysis, decide whether to invest in the stock. Remember, investing is a long-term game. Don't make impulsive decisions based on short-term market fluctuations. Remember, fundamental analysis is a skill that takes time and practice to develop. Don't be afraid to make mistakes. The key is to learn from them and keep improving your skills. Alright, let's take a moment to recap what we've covered today. We've learned that fundamental analysis is all about determining the intrinsic value of a company. We've explored the key financial statements, the income statement, balance sheet, and cash flow statement. We've looked at important ratios like PE, D/E, and ROE. And we've discussed the importance of qualitative factors like management, competitive advantage, and industry outlook. The key takeaway is that fundamental analysis is a powerful tool for making informed investment decisions. It allows you to cut through the noise and understand what a company is really worth. And that's the key to long-term investing success. By understanding the fundamentals, you're not just gambling. You're making informed decisions based on real data and insights. So, there you have it, a storyteller's guide to fundamental analysis. I hope you found this episode helpful and informative. Remember, investing is a journey, not a destination. Keep learning, keep exploring, and keep making smart decisions with your money. Thank you for joining me on X100%. If you enjoyed this episode, please subscribe to the podcast and leave a review. It helps us reach more people and share our passion for investing. And as always, if you have any questions or comments, feel free to reach out to me on social media. Until next time, happy investing.